London, Reuters, an $11 billion, £8.12 billion, burst of biotech bids in just 4 days has fueled expectations of a 2018 surge in life science deals as large drug makers shop for promising assets from smaller rivals. Separate reports on Monday by consultancy EY and law firm Baker McKenzie both predict a significant rise in mergers and acquisitions, M&A, this year, helped by U.S. tax changes that may lift big companies' Euro trademark appetite for deals. Celgenia Euro trademark S, CELGO, up to $7 billion agreed takeover of Impact Biomedicines, Novo Nordisk Euro trademark S, Novo B.co, $3.1 billion offer for Ablinks, ABLX.BR, and Takeda Pharmaceuticals Euro trademark S, 4502.T, plan to buy TIGenix, G9U.BR, for $630 million have already got 2018 off to a flying start. This follows a relatively subdued 2017, when total life sciences M&A totaled around $200 billion, dominated by Johnson & Johnson Euro trademark S, JNJN, $30 billion purchase of Act Lion and Gelita Euro trademark S, GILDO, $12 billion acquisition of Kite. EY is confident this year a Euro trademark S deal value will exceed $200 billion, given companies' Euro trademark increased financial firepower and balance sheet strength. There is also substantial pent-up demand, with 60% of life sciences executives surveyed in October 2017 planning to actively pursue M&A in the next 12 months, compared with 46% in April. Baker McKenzie, meanwhile, predicts global healthcare M&A could rise 50% in 2018, with North America accounting for well over half of transactions. Driving the demand is the increasingly pivotal role of biotech firms in discovering the drugs of tomorrow. I believe you will see a higher proportion of innovation at an industry level and also at Novo Nordisk coming from external resources. Novo Euro trademark S Chief Financial Officer Jesper Brandgaard told Reuters. Ablinks is an example of strong technology development occurring in a smaller biotech setting, with considerable speed and a lack of some of the bureaucracy you can get at large pharma companies. Niche diseases. U.S. drug approvals hit a 21-year high in 2017, with 46 novel medicines winning a green light and a growing share of new products coming from younger biotech companies. For large drug makers, as well as big biotech businesses like Gilead and Celgene, small and innovative upstarts are now a vital source of experimental drugs with which to top up in-house development pipelines. Pricing pressures on established medicines for conditions like diabetes and respiratory disorders, as well as patent expiries on yesterday Euro trademark S blockbusters, are driving big players into niche disease areas where biotech groups often excel, according to Edison analyst and former fund manager Andy Smith. Euro pressures at big pharma look to be increasing and 90% of prescriptions in the US are now for generics, so that pushes companies to look at cutting-edge therapies and it takes them straight into the biotech wheelhouse. He said. Whether 2018 will turn out to be a golden year for biotech M&A remains to be seen, but investors like event-driven hedge fund Case Equity Partners have high hopes for the drug sector, following recent implementation of U.S. tax changes. EU.s. Companies with lots of cash trapped overseas can now put capital to work in the global M&A market more easily. We hence expect 2018 to be immensely active with multiple competitive auctions at significant premia. The fund said in an end-of-year letter. Although bankers say the U.S. tax overhaul and particularly a lower tax rate for the repatriation of cash held offshore has so far had limited impact on deal negotiations, they believe companies may decide to allocate more cash to M&A in 2018. The M&A outlook is likely to be a hot topic at the annual J.P. Morgan Healthcare Conference starting on Monday in San Francisco, when many biotech deals and alliances are often announced. Graphic for U.S. FDA approvals at 21-year high, click tmsnrt.rs/2hgom21.